Hey everyone, welcome back to Corporate Decoder, the place where we dive into the corporate world's paperwork. Today, we're cracking open a filing from Fidelity Private Credit Fund, and trust me, there's more than meets the eye, so strap in and let's get decoding. Let's start with the highlights. This is amendment number 3 to their registration statement, where they're registering an additional $3 billion of shares. A registration statement is like asking the government to let you sell a new product. And here the product is stock in their company. The total offering now sits at a whopping $4 billion. What is Fidelity Private Credit Fund? Well, it's a special kind of investment company called a business development company, or BDC for short. They lend money to smaller private companies, but the goal is to generate income. If they get good at this, all these middleman profits can trickle down to the investors like you and me who bought the shares. Who can invest? Well, the offering has some specific rules. To invest, you generally need an income of at least $70,000 and a net worth of $70,000 or a net worth of at least $250,000. Some states like Alabama, California, and others have even stricter rules. Where does Fidelity see an opportunity? The market has increased a lot in the past few years. Research suggests the US private credit market is worth about $1.8 trillion financing smaller mergers and acquisitions. So how does Fidelity decide where to put its money? Well, it gets tricky. Fidelity and its other managed accounts have various interests, so any potential investment and sales get distributed fairly according to their policies. As a BDC, Fidelity faces certain legal limitations when co-investing with their affiliates or doing joint transactions. However, they have an agreement with the SEC to allow co-investments, but subject to a lot of rules to avoid those conflicts. Now, what does Fidelity get out of this? 2 fees, a management fee and an incentive fee. The management fee is 1.25% of the fund's net asset value, paid every month. It's like a subscription fee for Fidelity to manage the fund, and is fairly standard for this kind of fund. The incentive fee is where things get interesting. It is paid out based on returns of the fund's income or capital gains, which we'll see further down. Speaking of fees, let's take a quick glance at those. You are paying fees for sure when buying. Here we get a side-by-side look at all the expenses for the different classes of shares. For Class S, you can expect total annual expenses to be around 7.522%. As a shareholder, you will be paying for portfolio management, potential incentive fees, and those distribution fees. As usual, it comes with a list of potential risks. So what is Fidelity worried about with this fund? First off, these shares are not liquid and appropriate only as long-term investment. The fund has a share repurchase program, but only a limited number of shares are eligible. You can't even guarantee they will pay distributions. They may also use borrowed money or the sale of assets to fund distributions, which is concerning. Let's take a minute to understand what their strategy is. They're shooting for income and capital appreciation by investing in private companies, with at least 80% of assets in what they call private credit. Let's peek at the senior securities. Senior securities are the instruments they use to get leveraged debt. The idea behind these loans is that as people invest, there are more loans to private companies. They can pay higher fees or give larger amounts of interest back to the people who initially invested. Okay, let's get a bit into the real numbers. For Class I shares, we're seeing a starting net asset value of $25.81, ending the period at $25.75. That's not a great thing to see, as it shows losses in value of the held assets. The incentive fees themselves are nothing at the moment. They didn't make enough for the incentive, but it's something we should definitely watch because based on the advisory agreement, it can end up being quite expensive to the fund. What are they actually looking for when selecting investments? They emphasize a consistent and disciplined underwriting process, which is the foundation for its approach to portfolio construction. That sounds pretty boring, but here's what it really means. They like to analyze companies, see if they're solid. They are all about the credit quality investment opportunities. Also, they make sure any new investment falls into the appropriate risk profile. How does Fidelity plan to use the money it's raising? The gross proceeds raised in the offering. 1/3 are from Class A, 1/3 is from Class D, and 1/3 are from Class I. The major use of the net proceeds will be investing. Operating expenses will be next, followed by fund repurchases and then general purpose. I can't help but think if the order were reversed, this company might actually be worth more. Now, what's my take on Fidelity Private Credit Fund? They're positioning themselves in a growing but risky area. Lending to middle market companies. Their connection to Fidelity Investments is definitely a strong point, so it gives them research and experience. However, this fund does depend greatly on a key few people on the investment committee, and its complexity and fee structure seems somewhat dubious. The lack of liquidity should also make prospective investors weary. Do your homework. Is this the private credit world's golden ticket or a potentially turbulent ride? Maybe a bit of both. Be careful out there. Thanks for tuning in. If you like the video, please subscribe, leave a comment, and hit that like button. Until next time,